Commodity prices remain robust, though, according to Rio Tinto. The mining giant is briefing investors this evening that its order books are full and work is progressing on $27 billion worth of capital projects, with another $35 billion pipeline of unapproved ones. But Rio Tinto also warned of a more cautious customer sentiment and softer physical markets than 6 months ago. I spoke to Chief Executive Tom Albanese in London a short time ago. Tom Albanese, welcome to Lateline Business.
Great to be here today.
Now, you said recently in Perth, we are going to climb a wall of worry over the next 10 years, but be ready for growth. Now, look, we are worried, and you talked to the top investors, bankers, politicians. What's your sense of Europe at the moment?
I think, first of all, in terms of Rio Tinto's business, we're in great shape. We're watching very closely what's happening in Europe, what's happening in the U.S. It hasn't had any appreciable effect on our businesses. Our order books remain quite firm. I do spend quite a bit of time talking with our investors in Europe and in the U.S., and there's quite a bit of anxiety about where will the euro be going, what's happening in Greece. Again, the reports that you've seen today about the downgrade of Italian debt, and of course the need to balance the budgets in the U.S. These are actually quite large factors and ultimately are having the effect of playing through and dampening investor and business confidence. So we have to be realistic and watchful for that. But in terms of our primary businesses, our core businesses, I think they've been continuing to be strong, even notwithstanding these concerns.
You've stressed today your strong balance sheet. Net debt you've brought down to $7.6 billion. But if banks do stop lending, won't that impact on the corporate market and your ability to roll over at favourable rates?
Well, we've been taking advantage of these current low long-term rates, and we've been structuring our debt over longer periods of time. Just as a matter of fact, just last week, we were successful in rolling forward $2 billion of debt in some quite attractive markets. So again, we do see a very attractive yield curve, and we're taking full advantage of it.
Could the things going on in Europe, a real crisis, could a real crisis actually impact your full-year results?
As we look at our businesses right now, I would say that the primary drivers for our business, being iron ore, copper, and the bulks, are largely unaffected by what we're seeing right now, and I would expect that to be continuing for the next several months, barring anything unforeseen and very difficult happening in the world markets. For example, our iron ore businesses, we are running quite well. We've continued to focus on hitting 240,000 tons for the year. We have quarterly pricing, so largely our pricing has been locked in for the rest of the year. Copper, while copper prices have dropped off a bit, they've not dropped off a lot, largely because of supply concerns. Aluminum pricing, while they've dropped off, they're now actually below the marginal cost of production. So against any further drops in aluminum price, we'll probably see a drop off in any supply. And I think for coal, for the most part, coal is probably more defensive than some of the other energy products. So I think those prices and the volumes have held up well in the seaborne market.
You do mention tight project financing and how it is harder to bring capital projects in on time and on budget. Is that going to be a worldwide thing or more particularly a concern in frontier markets like Mongolia?
No, I think well, first of all, I want to just say that we are continuing to push ahead with all of our large capital projects. We've approved over $10 billion over the past year. These are all quality projects, and they're all moving forward. And particularly, as I mentioned today, our expansion of 283 in the Pilbara is on time and on budget. But if I look around the world, particularly to smaller projects, and these are smaller projects, they could be in Australia, they could be in Mongolia, they could be anywhere in the world, I think we're finding that that it's more difficult, if you don't have the balance sheet to support it, to tap into the financial markets, to tap into the debt markets for those projects. And I think to some extent that will have a knock-on effect of delaying some of the supply response that we may have expected even, say, 6 months to a year ago.
Now, back in Australia, in the Pilbara in particular, we've had cries from the unions that they're storming the Rio Citadel. 400 train drivers get power to collectively bargain. And then the federal court, of course, throwing out one of your employment agreements as void. Should investors be wary of a change in the IR landscape here?
I believe that Australia is a great place to invest. We have, again, put a large portion of our total investment budget in Australia. It's certainly a very important part of the business. I get to Australia on a regular basis. And again, I think that we do watch what's going on in Australia in terms of taxes, the IRR scene on a regular basis, but it is a great place to invest. In terms of industrial relations, our view has been that, this is whether as a company or as an individual, when I visit mines, I regularly like to speak not only with the managers but also with the employees. I do see a high level of interaction, a high level of direct engagement with employees, and I think that actually is good for the company, and it's good for the individual employees. And again, I continue to support that, and that has been our approach in Australia and again around the world. From my perspective, the key for running safe operations, to run productive operations, is to have good engagement. And again, from my own perspective, good engagement also leads to higher levels of efficiency, higher levels of effectiveness, and it's a better equation all around. So I support that, and I think that's what Sam Walsh and the team have been doing in Western Australia, but our other products and our other product groups have been doing throughout Australia.
We've now got New South Wales on top of Western Australia, bringing in increasing royalties, even before the mining tax comes in. Now, the feds are supposed to compensate you here. There may be cash flow issues, timing issues for Rio Tinto. But what if this leads to the federal government deciding to increase the mining tax?
Well, we are talking with, again, the New South Wales government about what their proposal is and what it means for us. So again, we'll be engaging with the government on that. But I continue to be supportive of the government's efforts to bring through the MRRT on the basis as articulated by the transition policy team earlier this year. Now, we've like everyone else, have seen the 650-page, I believe, document just this weekend, and we're going through in quite a bit of detail as we speak. But again, I think that it does represent something that will lead to higher taxes from mining companies, but I think it's something that's actually fair and it's balanced, and again, I will continue to support it.
And just on the carbon tax, you've said that the Australian government should be wary of experimenting with its economy. That is, in fact, the envy of the world. Has the experiment gone too far already?
Well, I mean, since I said that, I believe back in July, if anything, we've had more anxiety in other parts of the world, particularly in North America and in Europe. So I think Australia's special position in the world economy, its strategic advantages in terms of supplying into the emerging markets, is something that is the envy of the world, if anything more than it would have been before. But that being said, I think that I've seen a greater level of anxiety and tension in Australia about what the accumulation of taxes will mean for the average Australian business and for Australian jobs. And so for our part, we have long been a supporter of recognizing there needs to be carbon pricing. It preferably needs to be done on a global basis, but if it's done on a case-by-case, as a country-by-country basis, as we have proposed in Australia, our preference would be something that is gradual, that is tested to determine if this makes sense, if this is having an effect, and doesn't become an experiment on, again, what I would say is an economy that's the envy of the world.
Tom Albanese, I thank you very much for joining us tonight.
Great to be here again. Thanks.